Yeah, Dhiraj Agarwal is now joining us from Ambit to talk about market fundamentals. Dhiraj, thank you very much for your time this afternoon. How are you looking at the broader landscape we are operating in the market? On the one hand, RBI governor just yesterday made a comment that we are now at the cusp of structural shift in growth, 8% on a sustainable basis positive. Other macro indicators are looking very handsome. But on the other hand, on micros, many companies are now sounding cautious for Q1. Stock prices, meanwhile, are just ignoring all of that and running away. What's the prudent strategy to approach the market if one is sitting on handsome gains?
I think the markets will continue to be choppy this year. It has been very choppy so far YTD. Save and except June has been a very surprising one-way rally after the election day dip, which actually has taken the YTD gains to almost 9.5%. But otherwise, I've held the view for a while that this will be the year of what I call non-linear markets, which means we will get violent both sides moves in the market. And when we look at the overall performance at the end of the year, it will be in a plus minus single digit kind of a range, perhaps, and not anything fancier than that. So as you rightly said, macros are looking good in a number of pockets within the corporate sector performance. There are signs of weakness. Maybe some of that get addressed going forward. And valuations are a little bit stretched. So there will be push and pull on the market on both sides right through this year as well.
Dhiraj, hi, morning. Let's understand your outlook then as to where you stand when it comes to the overall liquidity situation. Is it that you believe that FIIs will continue to remain on the sidelines, or that the once we get more clarity with respect to the budget, now that the elections are out of the way, we will see a continued flow of FII interest into the Indian markets?
It's a toss-up. It's very difficult to predict. I think liquidity is impossible to predict, right? So even the continuous dip in the FI holding in the Indian markets in the last 3 or 4 years has surprised many of us because economically the country is doing well. Markets have been doing well, but yet the FI holding of Indian market is at a decadal low of 18.5%, down from a peak of 21%. So which way that sits, I think it's not just a question around elections, the question around how the budget is, it's also alternate allocation. At least for a couple of months, China pulled in a large amount of inflows by the global investors. I haven't seen the most recent data, but Feb, March, they pulled in about $40 billion. Something like that happens, it obviously impacts the amount of flow which could happen in India. So on the FPI flow, it's just a toss-up. I mean, it's very difficult to predict, honestly.
Which are the parts of the market which you are still finding attractive risk reward from here on, Dhiraj?
So I've been talking about of late what I broadly say winds of change. There are some signs of winds of change in the last 2 months, which looks like, while one has been fundamentally feeling like that for a while, looks like the money flow is also moving in that direction right now. So one has been feeling for a while that banks, especially the private banks, have underperformed for a prolonged period of time. Valuations have become reasonable. Businesses are doing okay. And that's one segment which could come back into outperformance trajectory. Last 1 week or 2 weeks of moves actually points towards possibility of that happening or getting momentum. So that's one space. The other, not turned around yet, but very interestingly poised could be IT services. That has also underperformed over the last 12 or 18 months. My sense is most of the bad news is priced in. So it probably doesn't get worse from here. Do we get an inflection immediately in the short run, or will we require some more patience for that is a question mark. The third space, which is not a large sector, but medium size, is chemicals. There are some signs of bottoming out there after, again, 2 to 3. So basically, my thinking at this point of time is to focus on sectors which have underperformed in the last 2 or 3 years and be very watchful of signs of turnaround, either in fundamentals or in terms of liquidity flow or both.
Yeah, very interesting. Yesterday, I was talking to 2 agrochemical companies here on the channel. Interestingly, both were talking about how they are witnessing pricing power coming back, demand improvement, and the severity of Chinese dumping actually reducing. And both have actually calling about second half of the year and very hesitatingly talking about decent FY25 prospects. Would you start nibbling in domestic agro-focused companies because you are looking at chemicals, or you would go for much more complex guys, SRF, PIs of the world?
No, I would. Complex guys probably haven't fully turned around the corner yet. It's pretty close maybe. But you're right. The agrochemicals and the whatever the so-called more commoditized space is looking more interesting at this point of time, relatively speaking.
Right.
What would you think, Dhiraj, would be, the next big trigger for the equity markets? I know you flagged off that flows are not purely contingent on a lot of fundamental events, but just going by how the markets are currently, where the markets are currently at, what do you think is going to be the next key trigger or triggers?
Budget could be a trigger, but the way I'm thinking at this point of time, with the market at 23,800 approximately Nifty, budget trigger could either be neutral or negative. I don't think budget can do anything which can be a meaningfully additional positive trigger from here on, right? Because most of the market expects the government to carry on with the continuation of the whole capex program and policies. There are some expectations that there could be a little bit of consumption boost kind of incentives built into the budget as well after slightly weak performance in the elections. But I don't think, unless there's a huge tilt in that direction, I don't think that'll be a big disappointment as well. So I think around the budget, one should closely watch if the market goes into a little bit of a correction.
I want to come back to the point on IT once again, because it is about returns, and where do you see better returns to be made? Some of the guys in the mid-cap IT, which actually cater to a specialized set of services or clients or niches they offer, are actually not slowing down on their growth outlook or even, declared numbers. In fact, they are buying out, companies and stuff like that. The larger ones are much more cautious. Their numbers are not very impressive, but both have undergone corrective phases. Which side would you find more comfort buying into?
The market is, last 2 or 3 years, our market has become more retail dominant, right? Obviously, much of the retail money is going into institutions, but somehow the dominance of retail investors in the market and moving or setting the stock price expectations has become very, very powerful. And retail is focusing on one single metric at this point of time, which is growth. So I often call it as a growth chase as well. There's a growth chase in the market. The one metric people are looking for is growth. Sometimes we get confused that the growth is coming in the expense of cash flows, and yet the stock prices are moving up. But that's the nature of the market today. It's somewhat like what it was in the 90s. So as you rightly said, a few mid-cap names, a number of mid-cap smaller names are displaying better growth characteristics as compared to the large caps. And they have done better, and I think they may continue to do better going forward as well.
While, as a strategy, you're looking at some of the, underperforming sectors, would there be any other interesting niche plays maybe that you've observed by way of sectors that are interesting outperformers or have the potential to be outperformers in the market?
The one niche sector which has been doing very well, which can perhaps continue to do well, is EPC construction infrastructure, right? So that's one space where competition really came down after the previous cycle. So in the previous capex cycle of 2003-07, there were a huge number of EPC companies and competing viciously against each other. And many of them just died because they overextended the balance sheet, so just became too weak to compete. So at this point of time, that space has lesser number of competitors left. At this point of time, business is doing well, order books are strong. So that could be one. I mean, it's become sort of a niche sector now from that yardstick. So that could do well. Power is in a structural uptrend, although after the very strong performance of last 2 years, I think it might just take a breather. But if you want to take a longer term call, I think it's still in a structural uptrend.
You're playing the power theme, Dhiraj. They still say that massive demand supply gaps are existing and big addition are happening next 5-7 years. So this area should not be abandoned even if the stocks have actually moved up. But within the entire value chain of the power, which end are you most comfortable in?
I mean, everything has become expensive at this point of time. So, can you justify that there is growth for the next few years? Of course, yes, because there is power deficit, and investments are picking up. But can you justify valuations in a number of cases? A little difficult. But at the same time, you're right. I mean, if a sector stays in a very high growth phase for a long period of time, we have seen valuations sustain at unrealistic levels. I mean, it happened to the consumer stocks between 2014 to 20. Why can't it happen to power today? So at these prices, these valuations, I would just either pick some relative softness in valuation, or will just probably just do a basket approach.
Okay, fair enough. That's the view coming in. But what is the outlook in specific? If you could just elaborate when it comes to some of the rate sensitives, in particular, auto, for instance. We have seen the introduction of EV, a lot of newer models. The competition seems to be heating up. What is the outlook when it comes to auto in specific?
I mean, auto has had a fantastic run over the last 1 or 2 years. And I'm generally slightly cautious on anything which has had a fantastic run over the last 2 years. Nothing to do with the earnings outlook or fundamentals, but simply because they've run too hard, too strong. Valuations are a bit overstretched, and everything corrects, everything consolidates. I think it's time for a bit of a consolidation there.
All right, Dhiraj, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
That was Dhiraj Agarwal from Ambit Investment Managers. But Rakesh Arora now.
If you like this video, then like, share and subscribe to ET Now.